Hey, welcome everybody to another episode of our Presidio Perspective podcast. I'm Dustin TenBroeck.
I'm Luke Jacobson. Thanks for joining us today.
So, Luke, we got plenty has gone on since the last time we addressed the audience in our podcast, especially over the last, 24, 48 hours.
Oh, really? What's going on? I haven't seen anything.
So we reshuffled the agenda in real time there. But so we have a little counter of some of the stuff that we're going to talk to you about on this brief podcast today, reviewing the election results, which are now finalized for the White House and for the House and Senate, and what that might mean. Going to talk about some Biden tax policy proposals and changes that we're going to be watching closely. Also, what's new on how this administration is going to address the pandemic, what this means for the economy, which we'll call the blue economy, as the Democrats have a sweep of the of the government houses, and also want to talk about some tough trades.
Tough trades.
So tough trades that I think a number of you are going to fall into one of two camps. And so we want to speak directly to a lot of the audience members here, of what to do now, right? Of what to do now. So let's start off with the election results. So we had a Democratic sweep, right? So we had the Georgia Senate runoff. Both seats went Democrat. So that's a 50-50 split in the Senate, with the vice president being the tying vote, right?
That's right.
So with a Harris-Biden White House, we now have a Democratic president, a Democratic-controlled Senate, and a Democratic majority in the House of Representatives as well.
Right, and whether you fit on the camp of that was in expectations or not expectations, I think that generally speaking, the market doing what it's done over the last, since the election, but especially in the last year to date. Yeah. Has been favorable to market participants and somewhat outside of at least my personal expectations. So I'm very happy to see lots of excitement and about the new movement here.
Yeah, absolutely. So we'll get to some of those underlying reasons why the market has been so favorable with the election results. I think one of them is that there's just results, right? I mean, that's, I think, the number one thing that the overhang is, what's going to happen? Just these unknowns. The market hates the unknown. It likes the known. Pick a lane, pick a direction, and we know what we're dealing with as business owners and boards. They know how to position their businesses for strategy and marketing and et cetera. So hiring, building new infrastructure, whatever it might be. So I think just having results is always a really positive thing for the markets, and something we were trying to communicate as much as possible to investors who are waiting on the sidelines last year. We think about the headlines in front of us, not the ones that we're reading today, but what are some of the potential headlines? And so the market has results. We don't have the overhang of wondering anymore of which way it's going to go. Right?
That's very true. Yeah. And so
imagine betting on the Super Bowl after the game's over.
It's kind of nuts.
Yeah,
it is kind of nuts. So there definitely feels to be an environment of stabilization and foundation as we start the new year versus how we ended it. And I think just as I say that out loud, I can see how market participants, multiples, and forward-looking estimates would start to get excited about a stable scenario. Right. I'll just say that again, stable. I actually really like that. So as we think about that.
Are you inferring that things have been not stable, Luke?
Well, if I just think about all the conversations I've had in the last 6 months of I'm just going to wait for the election, I'm going to wait till next year, I'm going to wait. And there's been a lot of great reasons to think about that. However, pretty much all the decisions have been challenged now by market moves. And so those decisions are now even more difficult than they were 3 months ago.
Yeah. And we'll talk about that in tough trades, and investors can benefit from the learnings that they've had, the education we've had over the last, 12 months, 6 months, 3 months, et cetera. So let's talk a little bit about this, a Biden White House, because he has some tax proposals that he'd like to see get done. He has a better chance of getting some stuff done, correct, with a democratically controlled Congress now.
Absolutely. That seems to be the case with having the votes.
Yeah. And so we're going to look at some things, and it's not radical tax policy changes, in my personal opinion, but they are some significant changes that are going to affect a number of our clients and prospective clients out there that might have. So one of the things is obviously there was the Tax Cuts and Jobs Act, right, that went into effect during the Trump administration, lowered overall tax rates for everybody. Right, corporations personal taxes, especially corporations, but certainly on the personal ordinary income tax. And so one of the first things would be to kind of repeal that and go back to the higher maximum rates. Is one option. Of course, there's nothing that has to be done because those personal tax rates will go up automatically when the sunset of those laws go into effect after 2026. But one of the things that I think Biden is targeting that we've been aware of is the higher capital gains rate.
That's right.
So as my understanding is for taxpayers that have adjusted gross income over $1 million, will potentially face a maximum or have their capital gains tax rate equal to their ordinary income rate, which would be under the Biden's tax proposal 39.6 or 37%, depending on what happens with ordinary income taxes.
That's right. Plus a potential add-on benefit or add-on tax of that 3.8% to even move it beyond 39.6. But either way, those earning over $1 million will be paying a substantial amount of tax on investments, and that would be a substantial change that we haven't had for decades, potentially even longer.
Yeah, so that's over a 44. So it's about 44.5% long-term capital gains tax rate on individuals who make more than $1 million. So I think for most people out there, this isn't going to affect them. For most people. Some people might get adversely affected by this. If they have a really big income tax year, they sell their business, they sell a piece of real estate, they have a really good income tax year with some large capital gains in their portfolios or a combination of any of those things I just said above, right?
Mm-hmm. That's right. And it effectively takes away a loophole that private equity and venture capital has used to pay capital gains tax rates instead of ordinary rates while they're earning probably not just simply above 1 million, but above substantial millions in a year. So likely a move that probably should have happened a long time ago, and probably a good move for us.
Yeah, I would imagine there might be some fight on where that line is drawn.
Certainly
on that income threshold. So we'll be watching that very closely. One of the other things that here in California we got greatly penalized for in the Trump era tax cuts was the limitations on itemized deductions. Mm-hmm. And so I see that maybe it's no wonder that California votes blue historically, but I mean, there was definitely seemed to be a shot at eliminating or putting limitations on our state taxes and property taxes at $10,000. And that seems like that would be repealed in this new proposal. Is that what you understand?
That's right. That would be a big windfall for clients and individuals in California.
Yeah. So I mean, if you couple those two things, you're kind of having some balancing where this is typically what we see. There's a lot of shifting in these tax policies, but where we come up might be on the margin, pretty much the same.
That's right.
Okay. But so that would definitely be a benefit to individuals. And here in California, as we, have higher property values, likely higher property taxes, but certainly pay higher state income tax. And so we've been limited on those deductions over the last several years. So just to finalize on that, there's a bunch of different proposals of things that we're watching, but two major ones that have to do with those who owned appreciated real estate. One is the potential elimination of 1031 exchange. And this has been talked about for a number of years through a number of administrations so far. Obviously, I don't think our last president being a real estate mogul we were too worried about 1031 and exchange going away. But that is where you could sell a piece of property, real property. So you sell your investment real estate, And if you had gains on that sale, you wouldn't have to recognize them for tax purposes if you exchanged it or bought another like-kind property or another investment property. So real estate investors have been able to defer their taxes and not pay taxes on the gains they make in real estate so long as they reinvest that into a new property. And that's been very lucrative for real estate investors. And then so long as they kind of do that game until they die, there's a step up in basis, right? Which means that at our death, all of our assets, the cost basis gets stepped up to its current value or the value of that property when we die. So when we transfer the property to our spouses or our children or whoever our beneficiaries are, they won't have any taxes that will be due. So if a husband and wife are together and one spouse passes away, the other spouse can liquidate the real estate portfolio and pay no taxes. So 1031 exchange is on the chopping block. And why I'm mentioning that with inheritance is because what's also on the chopping block is the step up of basis on some of these inherited assets. Right. And so for many, many real estate investors, I know, especially here in California, where we've seen such fantastic growth in real estate over the last, 20, 30 years, 40 years, fortunes have been built on 1031 exchange and have massive gains deferrals. And so that is something that investors, I believe, are going to be watching very closely, because there might have to be some really tough decisions before the fact that you want to get done if, in fact, those two tax laws are changed or amended.
Right. It really highlights the value of focusing on estate planning instead of the simplified version of putting all your assets in real estates and handing them off at a stepped up basis.
Yeah, it's just math.
Work.
It's just math.
Right.
We say that all the time. And so, sometimes to put together the mathematical equation of your assets over your lifetime is a pretty complex and long algorithm. But it is just math, and there's only a couple variables. So something that investors should be doing with their estates. Absolutely. So anything else I missed on tax policy you wanted to?
One thing I did notice about that was it looked like there's also some fixes to Social Security, which I actually find somewhat interesting, is that it seems like that's the one that we always want to kick the can down the road. And given how much work we do on Social Security here, on when to take it, when to not take it, it's nice to see someone finally addressing it. And actually, we'll see if that actually goes through, but it's kind of exciting to think that maybe I will actually have Social Security someday.
And I think fixing it comes from you paying more to fix it.
This is very true. Yeah. This is very true. I will pay to fix it. However, I'm happy to do that if that's the case. So
absolutely.
It's nice to not kick it down the road. Now, if you think about the other change that might happen with a Biden campaign, if you remember, they wanted a much larger stimulus bill, and they were looking for, I believe they spoke of the $900 billion payment as just simply a down payment. And so the market largely expects substantially larger stimulus payments here in the near future. So we don't know what that will be, but it sounds like it will be at least a multiple of the original $900 billion stimulus plan.
The $900 billion, and that was for how much for each American household?
I think it was $600 for each household up to certain income thresholds, with a $600 credit per dependent child.
Yeah, so per person, not household, right? And then there's talks about that being stepped up to $2,000, and then maybe a lot more ongoing aid and support beyond that.
That's right. And so let's think about so what happened to markets when we started thinking about more capital flooding the streets. So we've seen assets shoot up across the entire investment landscape, from traditional inflation-related assets to cryptocurrencies to like deflation in the dollar, you name it. There's been massive changes just in simply the last 4 days.
Right. So this is an anticipation of more money supply being out there in our economy, which typically will cause inflation, right? That's the mathematical output of having more money in the economy, is you're going to have the price of goods and services inflate over some period of time. So right now there's the anticipation of that money hitting the streets, as you say. And then there's actually going to be the event of the money coming out.
Right. And the way that stimulus is working right now through the economy and working through lots of individuals creates a substantially more inflationary effect than policy that we've seen over the last few decades, which have been more based on bailouts or providing liquidity for illiquid situations that cause destabilization.
This is a really important point that Luke's making, so I just want to speak directly to it. And so I have heard a number of folks, novices and professionals alike talk about the last great recession in 2008, 2009, and all the massive quantitative easing and stimulus that was injected into the economy, during that period, 11, 12 years ago. And I just want to make the point that is dramatically different than what we're talking about with this stimulus bill during this recession. The money that was used was to make banks solvent, right? When it happened a decade ago, we had, massive failures in our financial system, and without injecting capital on their balance sheets, we were potentially headed for a really bad scenario where you went to the ATM and, nothing happened. So to save our financial system, we injected a bunch of capital. That was the stimulus that went onto bank balance sheets, and there it sat. So if you put money into the banks, it doesn't cause inflation. So people will argue, hey, we've had stimulus before and we didn't see the inflation. Why is this different? So this is why. It's very, very different capitalizing banks versus giving checks to every American household, right? And every child, right? And anybody who's not working or unemployed, what happens with that money? I assure you very little shows up in a savings account at a bank, right? And what that money is used to do is buy goods and services that are required for life, but that is, fueling the economy.
Right. And I mean, really what you get down to when you hand down $2,000 checks to households is you get down into, if any of you are paying attention in your university studies, you are getting down to quantity demanded and quantity supplied, which gets into things like really inflationary pressures. And I guess the way to think about it is stimulus right now is based on social unrest to help people achieve a better life in their current life versus handing out stimulus for liquidity reasons to keep people employed. Very, very different.
So all of this is to say one of the reasons why we think the market really likes the election results, one of the number one reasons that Wall Street favors that Biden presidency and now a democratically controlled Senate. One argument for that would be this is going to be dramatically increasing the likelihood of more stimulus for the future, making that a lot easier.
That's right.
Which is, in the short run, very good for the economy.
That's right.
And so therefore the stock market.
Therefore the stock market. And really the economy, as we're seeing recently, and as we've actually talked about in our investment meetings recently, we're seeing a massive change in the type of economy that we expect to have in the near term and even potentially the long term. So I think we're talking about the blue economy.
Yeah. That's a nice segue. Go ahead and let's talk about what else in this blue economy where we have now democratically controlled House, Senate, White House. What does that mean for the economy?
I think one of the key things that we're looking for is infrastructure spending. So an infrastructure bill, despite the last 4 years of having real estate being the top of our president's career before he was president, the Biden plan has really talked about massive stimulus from an infrastructure spending plan. And so within after the Georgia results, we saw names within aggregates, cement,
materials,
right? Steel across the board move upward of 10% in one day. Yeah. I think we were talking about that aggregate pile down the road, like that pile of rocks is now worth 15% more today because of this plan. And I think that's really important to think about what that means for a change in the market. Last year, we saw outperforming NASDAQ and technology and stay-at-home trends, and people have made substantial successes based on that. And as we move forward, we're talking about a very new type of growth, new stimulus spending, and so we're seeing changes in the market that really have to be paid attention to because things are really changing.
Right. And so in general senses, so not any specific companies, but in general senses, what types of companies are we looking at? Like you said, there's materials, there's cyclicals. We're just thinking infrastructure, right? And we're building, right? So you need materials. We're mobilizing a workforce. You're having higher employment rates. So there's inflationary forces at bay. And then you're just thinking of the things that lubricate and keep the economy moving. So you're also talking about the railroads and the production and the manufacturing and the industrials.
That's right. From services down to capital goods. the demand and supply curves just immediately shifted 2 days ago. And what's very interesting about those particular sectors is that they have tremendous pricing power. There are a finite set of goods in the world to meet the needs of our infrastructure spending. And those finite goods now have they just met a substantial shift in demand, which just immediately raises prices. And they have pricing power. So in addition to that, and we talked about this in our last episode, you have China's GDP growing at substantial rates and them having positive net fixed asset investment, excuse me. And so you have more than just the United States now chasing these goods. You have a worldwide economy. And it's something that I've been talking about, moving back to the 2006, 2007 playbook. And that's kind of how we've been looking at our portfolios and thinking about investments and really starting to challenge the mindset of NASDAQ, stay at home, pandemic. We're just going to do that for the next 3 years. And you're seeing really, really difficult churning conditions in the market. Whereas, as of today, I just printed these out with the S&P up barely 1% for the year. We have mid caps, small caps up high single digits, while oil services, a name that I don't think anyone would have invested in last year, is up it's in double digit territory.
Right.
So you're seeing the pain trade, as we like to call it on the street, not only just show its horns, but it's accelerating and causing a lot of turmoil for active managers and wealth managers for right now. Yeah. So a lot of changes on the horizon with the Biden campaign, and I think the big theory to really hone in on is pricing power and inflation, and when does that really start to gain? And I think it'll be an interesting discussion to hear, because those two comments have been something that we've been able to push away for really the last decade, if not 2 decades.
Yeah, and I think the final thing on that too is one thing with this blue economy and something that, and actually to finalize the infrastructure point, there was a lot of talk about that in Trump's, I think, when he was running for president, talking about a big infrastructure spending bill that didn't get done. Obviously, we had, a pandemic and things at the end. So, but we think it's different this time and likely have the momentum now with control of the House and Senate to get that done. The other thing to touch on, right, is looking at international in our portfolio versus domestic, and maybe taking a keen eye on emerging markets.
Right. We've seen a weakness in the dollar, which has a lot to do with handing out checks to individuals. It does perceive weakness in our currency as we are somewhat diluting our currency. We are handing out money. And so we're seeing emerging markets improve in this environment. But we're also seeing a lot of emerging markets improve simply because they have a handle on the virus more than we do.
Right. Specifically China, I think you're right.
Specifically China, and also I think New Zealand has done really well in handling their handling the coronavirus right now. And so you're seeing a lot of opportunities where suddenly they could be growing at rates substantially faster than US GDP rates. And so what is that really manifested in that's really caught my attention is the 10-year yield. So let's think about where the 10-year yield was a year ago today. It was at 1.9%. In the worst of the pandemic, it was down to 30 basis points, 0.3%. And now it's back to, I think I left my desk, 1.09%.
Right.
And so what has happened to, say, the aggregate index, an index that covers the bond index over year to date, it's in negative territory. And so why are we seeing such exuberance to get into assets that might cover inflationary conditions, such as the stock market? A lot of it is because there is tremendous capital in fixed income, because it's where it needs to be, that is moving even just marginally into equity assets. It doesn't take a lot of capital to move on the margin to boost the market. And so we're seeing just the beginning of that. And I think we're going to have to figure out where that goes from here.
Yeah, there's a lot of places for it to go, right? But one thing that you're not alone in is looking at where it sits today, with the trillions of dollars that sit in fixed income. Looking at the potential over the next year of kind of a best case scenario of breaking even or losing 2 or 3% would be what many fixed income managers might chalk up as a win for the at least what it looks like today on the horizon.
Right. So, and I think if I just pointed out the dispersion right now, and what are we, the 8th of January? The dispersion in the market is tremendous. S&P at single digits, low single digits, while other sectors already at high single digits. And I think this year could be a year where you see tremendous dispersion in assets. And without the constant monitoring of a portfolio, I think people could find themselves not having great years in their portfolios without that. So something to really look at.
So this really, and I've been biting my tongue to get to this last segment because everything that we've been talking about is talking about these tough trades. And specifically, I'm thinking of two types of portfolios. The first type has just got off of a very nice year, right? And they potentially did all the right things, either because they were lucky, very smart, very stupid, whatever the reason
Whatever
is.
it was, they were in stay-at-home stocks.
They got
Tesla,
through the pandemic, right? And they owned the right stuff. And they have seen a tremendous growth in their portfolios. Many of them are chalking up a big win and getting ready for another potentially big year. But we think there might be some pitfalls that they're going to have some rude awakenings going forward. So, this is what we want to talk about, rebalancing, I think, specifically. And I think what, most of what we've covered so far in this episode is everything that we're looking at from the economy. We're looking at favoring, potentially emerging markets, international versus domestic. We're looking at cyclical value industrials versus high growth and tech. Basically everything that has worked. We're looking at all those things that haven't. And oftentimes, right, when you rebalance a portfolio, you're going to sell the things that are high to buy the things that are low to bring your portfolio back to balance. And having some discipline to buy low and sell high, by the way, that's how you make money in investing, right? And you lose money doing the opposite, right? So if you're selling the things that you lost money and buying the things that won, which is what most people do in this country and in their stock portfolios, they like many individuals this month who have 401ks at their companies are making decisions, and they're going to look at the funds in their 401k and look at what did well last year and say, oh, I need to go more into that. And they're going to look at what they were in that did not do well, say, I need to get out of this. But that's some very flawed thinking. So we really want to speak to those individuals and try to help them with some tough trades. What do they need to look to do?
Well, and sometimes that works. Every year is not the same. This year, we're seeing substantially different markets develop, and securities that have done substantially well last year in the beginning of our economic growth cycle did so largely because of tremendous multiple expansion. And that multiple expansion tends to hand over to part two of the growing economy, where we move into actual revenue growth, earnings growth, and stability. And while we see huge changes in interest rates, as we talked about with the 10-year, we're starting to see the baton get simply passed to other sectors and industries: oil services, financials, industrial, cyclicals. And I'm not just simply talking about growth versus value. I'm not just that. I think that that's entirely too simplistic for how we're looking right now. And I think something that we've really talked about and ad nauseum for the last 4 months has been momentum. And momentum is an interesting thing. That momentum has been around and really been a winning part of the market for the better part of 3 years. And so in order for people to participate the market or potentially even beat the market, they're finding themselves in momentum, even though there isn't one word of momentum involved in any security or fund that they actually own. So it's something that happens and becomes an unintended bet. And so actually being able to see the forest from the trees and find that you actually have momentum within your portfolio, even though you have no idea that you own momentum, is really something that individuals need to be looking at right now.
I really like that question. I've heard you ask it to your clients, and if you ever speak to Luke, he'll ask you, what are the unintended bets that you have made in your portfolio? And every time you say it, you get this kind of look like, what are you talking about?
That's right.
But it's true. We buy into funds or buy into stocks for one reason or the other, not knowing that there's all of these factors, right, at play that are really choosing which are the ultimate decider of the performance of the overall security or fund that you're in. And we're not always aware of what those are. And so when you talk about the momentum or the price people are willing to pay for something, that's very fickle, right? And we've seen that happened before with many companies and markets and sectors where all of a sudden somebody's willing to pay 1,000 times the earnings for something until they're willing to pay 100, right? I mean, you're going to see a dramatic change to that portfolio and that security.
Historically, momentum tends to move upward in a escalator type fashion, but it tends to come down like an elevator. So
I don't like that.
I don't like that either. Like that. Very important to be paying attention to. But we're already seeing the beginnings of
so
that.
I want to be sensitive on the time, and I want to talk to this person a lot more. And so if you are that person, we're happy to talk to you. The other person that we want to talk to is perhaps a more painful trade. So one, very important, looking at your portfolio, recognizing what are your unintended bets, what has worked very well that maybe you should trim down your position or get out of completely and look for better opportunities in your portfolio. The other person that we want to talk to, and this is the more painful trade for many of them, is the one who sat out on the sidelines this whole time, waiting for everything to blow over. And this is really a painful place to be where, what we've seen, if you're watching the news, is that there's never seemingly clear skies ahead and everything's fine. And by the way, that's might be the worst time to invest, right? But what we see is a lot of chaos and madness happening all the time. And, I think investors can look at just this last year and what we've gone on and watch what's happened in different asset classes and markets and hopefully learn from this. But here we are, the S&P is over 3,800.
This just underscores the value of a plan, understanding why you're investing, and building a portfolio that enables you to participate in all market cycles. Because market timing is not only exceedingly difficult, but has been proven over and over again to fail.
So if we look at the math, we look at the history, the data is overwhelming that the stocks are on an upward trend over the long run and have downward trends temporarily, right? But we've proceeded to reach new highs, right? After every recession, that's just kind of how things work. So when we're trying to time markets, we have to have a really kind of short lens and know that we're doing some gambling here, because there's a lot of things that are outside of our control, a lot of unknown unknowns and known unknowns that we're waiting to see fall. And so, we're going to be really bad at predicting, I think, in my opinion, the stock market in the short term. However, if you've made some predictions, whatever those were, that the world was going to burn down, that capitalism was going to crumble, that there was going to be a coup in the White House, whatever your predictions were, so far those haven't come to be, and the market has inched along higher. And so now what do? You have to invest, right? I mean, you have to pick a strategy, right? So you work with your wealth manager, you find your asset allocation, but you have to have a jumping off point, because sitting on the sidelines, I'm worried, right, that is just going to become more and more painful. And unfortunately, Luke, you and I have seen those individuals over the last decade who sat on the sidelines for 10 years after the Great Recession, right? And missed out on a tremendous expansion of wealth that has gone on globally. And we really want to make sure that investors now, if that is you and you're on the sidelines, you need to have a plan to get your capital invested. And I can't stress that enough, right? Because this is just going to get worse. And by the way, inflation means that money that's sitting on the sidelines, cash, money markets, whatever you call it, is becoming worth less. Every moment, every second, every day, you're losing money. And so we want to make sure that we have a strategy and a plan for getting that capital reinvested.
That's right. The most difficult trade is actually getting back in.
Yeah. And it's not going to feel good. It never does in the short term, right? I mean, you have a hope, a wish, but we're long-term as investors. And so we can help people. If you're one of those two people, please give us a call. We're happy to help. And get your plan. Get your plan for rebalancing, get your plan for investing, and it's just math. So a whole lot that we want to talk about here, but we want to be sensitive of your time, cover some of these hot buttons. We'll talk on all of this stuff, a whole lot more, and we'll be back in 2 weeks, again, at the Presidio Perspective. I believe Thursday the 21st is what we're targeting. So stay tuned, check your email, and we'll see you soon. Have a wonderful weekend. Thank you.